This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So stage 2 of the process for working out inheritance tax is where there is additional tax on lifetime gifts as a result of death. So if in the previous 7 years prior to death somebody dies, and in that period of time there are some gifts, we need to re-look at them in view of the change in this individual's circumstances. So if there are, in that 7-year period, pets that have become chargeable, and also there might be some additional tax on the chargeable lifetime transfers. And obviously the person who has received the pet, or the person in the trust, the trustees, they will have to pay the tax that is now due on that. So how do we do that? We identify all the gifts within the 7 years of death, calculate the gross chargeable amount of each gift and any lifetime tax paid. So that would be stage 1. Then how much at nil rate band is available. Anything in excess is taxed at 40%. Take off taper relief if it's more than 3 years. If it's a CLT, then we obviously deduct anything that has been paid and state who will pay and the due date for payment. Now, as I mentioned before, number 5, taper relief. Let's have a look at what that is. You will be given some of this information in your tax table. So this information here is given to you in the tax tables. You don't have to remember it. So if a taxpayer does not survive for 7 years following a pet, but does survive at least 3 years, IHT payable is reduced by taper relief. So if it's between 3 and 4 years, then you get 20% relief. If it's between 4 and 5 years, you get 40%, and so on and so forth. So let's have a look at example number 2. So D died on the 1st of March 2024 with a chargeable estate, 500,000. Made the following lifetime gifts, and there are 3 of them. 1st of October 2011, 100,000 to her son. That's a pet. Now that will have had from it annual exemptions for the year in which this occurred, which is 11/12, and the previous year, because it's the first one, which is 10/11. So there's 6,000 come off that, which means the pet has a value of £94,000. There is no lifetime tax due on that because it's a potentially exempt transfer. On the 1st of June 2012, £336 in cash was paid into a trust, that's a CLT. And on the 1st of September, there is a pet. And we're going to deal with those in our answer. So first things first, A, calculate the IHT payable on the lifetime gifts when they were made, assuming that D paid any lifetime tax due. Now, if she's paying the tax rate is, remember, it's 25%. And then the B part, we are to calculate the IHT payable as a result of her death. So let's have a look how that's going to look in a pro forma. So step 1 is lifetime tax. And we have 2 that we're going to deal with here. The CLT, which was on the 1st of June 2012. And then the pet, which was on the 1st of September 2018. Obviously, the first pet, there is no tax. It's covered by that exemption part, potential exemption. So the transfer of value. This is 336,000. And this is 296,000. So let's deal with annual exemptions first. Current year. 1st of June 2012 is in 1213. So we have 3,000 there. And the previous year is 1112. Okay, I'm going to go back to the question because 1112 has been utilised in full. So don't ignore it, just write it like that. The annual exemption for the pet in 2018, so that's 1819. And the previous year, 1718, which has brought all our gifts down to 333,000, and this is now down to 290,000. Okay, so the CLT, this is a pet, therefore there is no lifetime tax. And I wanted to show you how that works. Obviously the first one we did just in a draft form. So this tax here, 300, wait a minute, let me just rub that out because we need a nil rate band, don't we? I don't know why I got that colour. Let's just put that back to the black colour, that might be better. There you go. Nil rate band, indented 325,000. Now we need to look back 7 years from June 2012 to the 1st of June 2005. Were there any chargeable transfers in that time? Well, no, there wasn't. There was only a pet, and that's not chargeable. So used, nothing. So the whole of that 325,000 can be deducted from there, leaving 8,000 taxable. So the 8,000, so IHT due, the 8,000 will be taxed at 25% because she is paying the tax. And that's the IHT due on the lifetime tax. So let's go back to the question. A, calculate the IHT payable on the lifetime gifts when they were made, assuming that D paid any lifetime tax due. So you could simply deal with the pets like that, and the same with this one, and just work out for the tax for that. Or you could lay each one of them out like this so that you know that you've dealt with everything correctly. It doesn't really matter which way, as long as you deal with everything, explain everything, and state the obvious. Now the B part is to work out the IHT payable as a result of D's death. Now when D dies, which is date of death, and change my pen back to that black one because it's better that way. Date of death. I always write it out like this. It was when I was learning my tax, my CTA, a long time ago. Somebody showed me this and it really helped me to work out this 7-year cumulative effect on the nil rate bands. Date of death, 1st of March. Let's just check. When did she die? 1st of March 2024. 1st of March 2024. A line has been drawn in the sand. We need to go back 7 years to the 1st of March 2017. That's the last 7 years of her life. Now, what we do now is to slot into this little diagram all the gifts that took place. So the first gift was in October 2011 October 11, and it was a pet. So what you're doing is just, this is a nice working, just to help you to understand how you're going to deal with stage 2. June 12. All of these were before, so that's a CLT. All these before, and then September 18. And that was a pet. Okay, now I'm going to change my pen back because I need to see all of this. All right. That pet in October 11 is now completely exempt. There was no lifetime tax. There is no additional tax on death, as in stage 2. So the £100,000 cash to the son, tax-free. This CLT in June 2012 is now no longer taxable, but it is going to have an effect because it's a chargeable transfer. Okay, this pet is now taxable, and I have got to revisit that position with that pet, taking into account, I'm going to go for a third colour here. What colour should we go for? Let's go for a bright green. No, it might not show up. Let's go for a green. When we deal with this pet here, we need to go back 7 years to September 11 to work out if there are any chargeable events that affect this for the nil rate band, and that one does. So let's have a look how that would work in a pro forma. We are only going to be dealing with the pet. It's only the pet that needs additional tax. So the pet is now taxable to IHT as a result of death. Okay, so the gross transfer is 290,000. Okay, nil rate band, £325,000. Okay, so that nil rate band needs to have that 7-year issue dealt with, and I need to go back and take off that the 333,000 from the CLT, this figure here. Therefore, there is no nil rate band available against that pet. So all of it is now taxable at 40%. So the IHT payable is 290,000 at 40%, which is 116,000 less. Now, if you do this, you need to do two things: one, taper relief, and one, tax paid. Now, we know there's no tax paid because it was a pet. So the taper relief is something that we need to be looking at. And the taper relief covers the periods. Let me just check. Did they survive for more than 3 years? Is there a difference between there and there of more than 3? Yes, there is. So September 18 to March 2024 is between 5 and 6 years. So between 5 and 6 years, we're looking at 5 to 6 years. And if we check the rates, that gives us taper relief of 60%. So 60% of this tax bill is now reduced, and we only have to pay the 40%, which is 46,400. So let's go back to the notes and see what we are going to deal with next. And that's the stage 3, the death estate.